I'm doing okay. Okay, so basically, Larry, you're going to walk us through like a tax personal cash flow analysis, essentially, for somebody who's you're trying to do an assessment of their tax returns, and what does that look like in terms of walking it through. So yes, why don't you dive in, and we'll ask questions as we go along.
All right. Well, this one's kind of similar. I think the last one I did with you, Dave, it's kind of the same one.
Okay.
I liked it because it was had a lot of moving parts to it, and you had both a husband and wife who have different companies. In this case, the husband has two companies, and the wife is an attorney. So I liked it because he took W-2 income and takes distributions. So there's a lot of kind of working parts to it. But so this is the form that I've been using for 20 years. It kind of gives me a complete snapshot of the borrower, their personal financial statement, other assets, liabilities. And then I itemize all their, on the top part, you see itemize all their debts and liabilities. And then over on the other side, I have little comments that I make as I'm, spreading the returns and personal financials. I just make little comments.
Right.
Oh, were you going to the actual tax returns?
Yeah, I was just gonna, as you go through it, I was just going to like toggle back and forth so that we could.
Yeah. So, for example, okay, going down to the personal cash flow summary, you have W-2 wages for husband. That's from his first company, and he took wages from his other company. So, those you see are his wages. Now, and those that can be taken from line 1.
Line 1, that's where you'd pull it from, right?
Yep.
Okay, and then I know it says restated. So what does that mean?
So yes, what happened in this case is a little complicated, but his company 2, he sold it in 2019. So when I do my personal tax return analysis, I like to show it as what income is recurring. That's what banks want to know. So since he sold his company, that W-2 income is gone. It's gone forever. So I basically in each year you see a column that says restated. I did away with that income.
Okay.
And one of the reasons for doing so is and I'll get down to this later, but you'll see we have, down below where it says FIT, SIT, that's federal income tax, state income tax, and FICA. So we calculate their tax bill. Well, if he's not getting this income, I got to reduce his tax liability because, what's on his tax return is based on what he earned. So I have to kind of restate that to put it in line with each other. So that's what that means. And but as we go through, you'll see why the tax bill is much lower. So as I said, line 1 is W-2 wages. Line 2,
interest.
2A and 3A, that's interest and dividends.
So do you on this one over here? So is it always going to show here in this section, or what's the distinction between the two here?
Well, tax exempt interest would be like your municipal bonds, stuff you don't have to pay federal income taxes on. Anything like bank accounts, brokerage accounts, people paying you, interest on private money, that would all be taxable interest for line 2B. And same thing with dividends. There's some dividends that you can invest in companies or certain companies or foreign companies and not have to pay taxes on their dividends that they pay. Okay. So IRS still wants to know about it, but you don't have to count it as income. So that's why you put that in box 2A and 3A. Okay. And then whatever is taxable gets reported in boxes 2B and 3B. I don't see much of 3A And I don't see much in 2A. 95% of it's going to be in box 2B and 3B, and that's reportable.
And then these, so that is going to show up here in the
Yep.
interest and dividends then.
Correct.
Okay, got it. So,
And
and the question you're asking, Larry, is this reoccurring?
Yeah, is this stuff recurring? To be honest with you, I don't, unless they have big investments, I don't really count. I do and I don't. If I have to, I don't always include interest because it's normally so nominal. But there are cases where you see if you got a borrower that does private money lending, then he's going to have a lot of money in interest, and that would be recurring. So it's kind of up to whoever's doing the spreading to deem what's recurring and not recurring, and what's material. I mean, is for $2,700 in interest, is that really material? Yeah, not in the scope of things, but sometimes it might be. But in this case, I didn't count it.
And then tax refunds, I'm surprised to see that on there. Is that because that?
So let me explain. Go back to the personal cash flow. Okay. So what you see on the upper top where it says federal tax return,
yeah,
that whole quadrant, that's exactly what's reported on the tax return. Okay.
Got it.
In the left column in each year, that's what's reported on the tax return. Okay. And to be honest with you, I don't restate a lot of tax returns because I just, not a lot of them have, this much discrepancy or differences because he sold that company. But so that gives me a snapshot of where all the income is, where it's coming from. That's reportable income on his tax return. It has nothing to do with cash flow, personal cash flow. Okay, you with me? It's just so, and I'll get to that in a second, but it's just to give you a clear picture. And my chief credit officer, bank president, give them a picture of like, where, what is taxable, reportable income levels are. All right. So, as we move down, so I just put tax refunds there as a, just to show them. And the same with Schedule C.
Yep. The Schedule C is going to be.
Well, now they moved it.
Okay.
So where that's going to be, you see line 7A?
Yep.
Their income, Schedule 1, line 9. So let's go to Schedule 1. So scroll down.
I don't know if this is going to have it on here.
Oh, you only got the 2-pager.
Yeah, so I guess I'll have to get Schedule C form.
Oh, yeah, they don't have the full taxes.
So let me pull that up.
So yes, that's.
This would be Schedule C, right?
Yep, it's just a sole proprietor.
Okay. So that's going to pull up. So then you'll go through and obviously try to figure out their net, or do you
pull up Schedule 1 too?
Schedule 1. Let me just do
that.
Just do that. Okay. That's it.
Yep. So you'll see in Schedule 1, they have Part 1, line 3, business income attached Schedule C. So you do the required to do Schedule C, roll that number up to line 3. I'll go back to the personal cash flow analysis.
Okay.
Capital gains. Now that's on the 1040 one.
Okay, so that's going to be
first page. Go to the scroll up.
Right here.
That line 6, that's capital gains. And then you'd have a Schedule D that you do in detail, and then roll that number up to line 6. And then let's scroll down. This is where it gets interesting.
Okay, so Schedule D, capital gains. And then Schedule E is rental income.
Right, and that's under the Schedule E under rental income, and then you got a Schedule E for partnerships, and
This would be your,
that's for income. So you report your property on the lines, and then property A in 1A, and you put your property address in there, and then you put the rents received and all the expenses, and then that number rolls up to that Schedule 1.
there's the Schedule 1 up here, right?
That's on the yeah. So
Or,
yeah,
or does that go here?
they really screwed up this the 2018 and 2019 tax returns stink. I mean, they went 20 years without changing it, and they really messed it up. But,
Yeah, I was gonna say so Schedule 1 is where it flows through
yeah.
to. Okay. So you put the capital gains, and same thing for that one as well. Schedule C is legitimate. I mean, are you just taking the number there, or are you actually going to go through and do a tax analysis on the Schedule C where you're taking?
Depends what it is, Dave. If that Schedule C is their business, yeah, I'll do the full analysis on it. It depends what it is. But I'll show you what I would do. So if you look down below, recurring income.
Yep.
I just add a line item that would say Schedule C net operating income, and then that's where I would put that number.
Got it. So up here, you're just line iteming everything. Down here, you're actually.
It's the cash flow.
Got it.
And I'll get to that in a second. So, for example, if you look in 2019, the wife's legal practice, Schedule E, the income from her legal practice was $155,087. All right, so they have to pay taxes on that $155,087.
Yep.
However, the true cash flow, what she got from that legal practice, was distributions of $124. So that's pretty different than what's the income was. A lot of people go, oh, 155,087, that's her income. Well, no, because that's what the company made, but she pulled out cash of 124,569, and you can find that on the Schedule K1.
Schedule K1, 19, which is going to look just like this, right here.
Yeah. So on K1, the ordinary business income, in that case, would be that 154 number. Okay, and then scroll down a little bit.
Okay.
And look at line 19, distributions. You'd see the 124 number in there. Your cash distributions.
Okay, perfect. And then obviously this is their percentage. So depending on if they're, whatever percentage ownership they have. Okay.
Yeah, there's a lot of information on the K1. That's why I always ask borrowers for their federal tax returns that include all K1 statements. I can't do a cash flow analysis without K1s.
What's the most important thing on this? The distributions,
I look at a couple things. The net income, of course, the
Yep.
ownership percentage.
Yep, which is over here.
Yep. And then down below, keep going, box L, the beginning capital account. Capital contributed during the year. A lot of banks, if you see a number in there, a lot of banks will count that as a deduction to personal cash flow because they money that you've invested in an LLC. And then obviously you see that box, a couple boxes down below, withdrawals and distributions.
Yep.
That's money, that's cash flow to the individual. And that number should always match which is in box 16 or 19.
Okay, here. So those two should be copacetic. Okay.
Yep.
Got it. Okay, so that makes sense. Okay. It's good. So you've got wages, interest, tax refunds, ski, D, E, all of their different businesses that they have.
Right, and you can, and this shows really, this shows the disparity between, um, the income reported and the distributions that the individuals actually get.
Yeah,
Uh, you can see that from the wife's legal practice. Um, you know,
yeah, that's huge.
2019 isn't a big deal, but look at 2018. Husband, company number one, made 67,000, but he took 49,000 in distributions.
Oh,
Then his company number two took 227,000 in distributions or in net income, and he took 192 in distributions.
okay.
So the recurring income, that down there is the true cash flow that we use for underwriting. You have to do the top part to get an idea of what their tax liability is going to be, right? Because you pay taxes on income that is declared.
Yeah.
Even though you didn't take cash, it's still income. So
Larry,
I have,
where are you going to pull on the 1040? They should show you the taxes. What here?
no, that's withheld.
Okay.
Add it's line 16.
So right here, total tax.
This is your total tax.
Okay. So that's basically has to be deducted. So that's going to be your FIT,
Yep.
but then your social and FICA.
Yeah. State income tax.
Okay.
If you don't get a
W-2.
well, if you don't get their state tax return,
Okay.
sometimes I'll just put a percentage in of like anywhere between 10 and 15% of what their federal tax liability was.
Okay. So that's a general rule of thumb, 10 to 15%.
Yeah. And then FICA is, I just take as 8% of W-2 wages.
Okay.
However, if it's over 120,000, it's capped at 120.
Okay.
In this case, but keep in mind, it's 120 per company. So if you look at 2019, he made 213,000. So I do 8% times 120 for that, and then 8% times 72,000 because that's another company.
Got it. Okay. So then you calculate your taxes, so federal, state, FICA.
Yep,
And just for someone who doesn't know what FICA is, what is that?
that's all your payroll taxes, Social Security, Medicare,
Medicaid.
all those withholding taxes,
Okay.
which totals about 8%. 7.65 is the actual number.
Okay. And then down here on the reoccurring income, you're basically taking salary, which should generally match up top.
Match with the top.
But the distributions is where things get really
They
interesting.
don't match. Yeah, they don't match. And you'll see a lot of times that sometimes you have to dig into that because you'll see that where they get a K1, there's nothing in the distributions. And sometimes I'll have to call and ask them, did you take a distribution? And if they said yes, I'm like, give me something from your accountant or someone that says that you, because it's not showing on your K1. And a lot of times their accountant may just correct it. But
So Larry, how do you handle it with respect to, so in this particular case, you get someone that has a, LLC.
yeah,
They don't file on their Schedule C. Do you still, because if someone gets the distribution, it's really, is that still the number you're going to focus on, or do you?
on their Schedule C, you mean?
Yeah.
No, I just use the net income as their distribution.
And do you add back in like depreciation?
Oh, yeah.
Okay.
Yeah, that's business cash flow.
Okay.
Yes, but I would do that.
But distributions are just distributions that they're taking out of the company, essentially.
Out of an LLC that's filing a separate tax return.
So just from a personal perspective, when someone's taking a distribution, that's the number that's going to go on here because that's coming down to them personally.
That's the cash that they get.
Got it. and then less total taxes, which you're taking from here.
Yep, just printing it down there.
Okay. And then,
And I inflate it. Normally, our bank rule of thumb is um, personal expenses. This one's higher, but normally our rule of thumb is 12,000 if you're single per year, 18,000 if you're married, and 6,000 per dependent.
per dependent. Okay.
So if you're married with 2 kids, it's the personal expenses is 48. Well, actually, I didn't. They have 4 kids, so
Okay. So you got 24.
24 and 18. Oh, I did 24 and 24. Uh, Given their real estate holdings and everything they have, their personal expenses are more than 24,000 a year. Plus, I know these people personally, and I know that number's low. So, but moving on here, so that's what I do. You got to give some type of a personal budget. So, 9.9 times out of 10, it's 12,000 single, 18,000 married, and then 6,000 per dependent.
That's great. Okay. And then you take out the debt service.
Then yes, I take out their debt service.
Okay. Right. And then you're obviously looking for a debt service coverage on the personal side.
No, as a matter of fact, we don't.
Okay.
We don't, because we're not doing residential lending.
Okay.
A lot of times I'll see where they're negative. If you look at their excess draw, that last line,
Yep.
it's very common where they'll be negative there. But now banks are doing it. We've over the past 8 years we've gone to a global cash flow.
Okay.
So we'll take their business and personal and combine it and do a global cash flow analysis.
Okay. And are you looking, like, what a couple of things when you're looking at somebody's net worth, et cetera, what is how big of a deal is the cash position, and what are you typically looking for once somebody actually closes with post-funding liquidity? Is there
Closing liquidity, that varies from deal to deal.
Okay.
It really does, and depending on what it is.
Okay.
We don't have a hard and fast rule of thumb, I can tell you that.
Every day's different.
But I'll tell you, if you're doing a startup, a business acquisition, anything, you're going to make sure there's decent post-closing liquidity.
Right.
So if things don't go as they plan, they've got a backstop to throw some more money into it. An example of where I wouldn't be as concerned with post-closing liquidity, if I had a guy that's had a tire shop, an auto repair facility, or that he's buying the building and he's throwing all the savings into the down payment, but his business is historically provided good cash flow, I wouldn't be as concerned about post-closing liquidity because he's shown that his business generates good cash flow. Does that make sense?
Makes total sense.
Or a doctor or something like that. They're buying their building or buying a building, they're throwing a ton of equity in it. I know they're going to generate cash flow immediately. They got an established client base and everything. So post closings, again, most important in startups and business acquisitions.
Got it. And then over here, you're looking at all their personal liabilities.
Correct.
So that they, how much they're cutting a check for every month, and
right.
Make sure that's all copacetic.
Yep.
That's good. Okay. So, I guess just high level wisdom points or advice when you're doing analysis like this that is important to notate? Like, I mean, you mentioned you always want to look for reoccurring things, and is there anything else that you would just suggest?
K1 statements for every year for every entity that is reported on their Schedule E.
That's a big deal for you
It
guys.
is, because it can paint a totally different picture, and it gives you a clear idea of exactly what they own in each entity. And entities that are reported on K1s are S corporations, LLCs, partnerships, limited liability partnerships, limited partnerships, general partnerships, all those entities. The only one that's really not, two of them that are not, a sole proprietorship, because that's on Schedule E, and a C corporation.
Okay. Yeah, that makes sense. Dan,
So
do you have any questions, Dan, or does this make sense how to size up the tax return that we just walked through, the 1040 to run a cash flow personally?
This is great, especially the K1 information too, because now we know exactly what to look for on that in order to translate it into what you actually are looking for from that personal financials. So that's perfect. Thank you.
yeah, oh, keep in mind, go back to this, I'll show you something interesting. So if you look at the Schedule D capital gains, so a lot of times you may not see anything there, but you'll see they have a capital gain, and you're like, where did that come from? Go to the K1 statement. You see lines 8, 9A.
Yep.
Yeah.
It can come from there too. So if you go back to the personal cash flow analysis, if you look in 2019 on his tax returns, the Schedule D capital gains, that actually came from his K1, that 560,000. And that's from when he sold his company in 2019. And that's why I restated everything. So a lot of banks, if a capital gain is not recurring, they won't include it in cash flow.
And is there ever really a situation where the bank is going to take a capital gain as a reoccurring?
If it's something that's done in the normal course of business.
Fix and flips?
What's that?
Like if somebody's fix and flipping all the time?
Yeah.
Yeah. I'm just trying to think of, I mean, that's the only one that at least stands out to me where you would actually take somebody's capital gain that, is reoccurring if they're doing flipping homes or something like that.
Yeah. And a lot of times I don't include the capital losses either, because to me I have them every year. I lose 3,000 in the stock market. I lose more in the stock market. The max you can deduct is 3,000.
Sure.
Some banks, some lenders will clip you for a capital gain loss, or capital loss, I should say. But to me, that's more passive. It's like cash that I had. It's not like I took money out of my W-2 and invested in something and lost it that year. It's something that I had excess cash and I put into an investment, and it went up, down, and I sold it, and might have sold it 2 or 3 years later at a loss. So I don't count capital losses as much in the personal cash flow analysis. And again, a lot of times they're not recurring. So
yeah, makes total sense. No, this is really, really helpful, Larry, because it helps us understand from your perspective what it is that we need to be preparing in order to do a cash flow analysis. So it's helpful for us to understand how to do a personal tax cash flow analysis. So we really